Good afternoon, everybody. My name is Marcos Morales. I'd like to welcome you all to the 2021 Black and Latino Economic Summit. Today, Hogar Hispano Inc. is hosting a summit on closing the racial wealth gap using housing as the method to do so. I'm the executive director of Hogar Hispano Inc. and Hogar Hispano Inc. has been in the business since 2004, but since 2012, we started buying REO in both bulk and directly from banks and servicers and other first look programs. And in 2013, we started buying non-performing loans for both foreclosure prevention and for new home ownership creation. So today we're going to talk to you about loan acquisitions to create and preserve affordable housing. We have an esteemed group of panelists, experts in the industry, and we are missing one. He'll be joining us in just a second. But I'd like to start off by introducing you to our moderator. Our moderator today is Sennai Cham. Sennai?
Thank you, Marcos, and thank you to the organizers and coordinators of this conference. I think the audience will find this conversation very beneficial. So as Marcos mentioned, my name is Sennai Cham. I'm a senior financial analyst at the Department of Housing and Urban Development in the Office of Asset Sales. So I'll just give a quick overview of what our office does. So our office was established essentially to dispose of defaulted single-family, multifamily, and healthcare mortgage notes. These asset sales help maximize recoveries while reducing claim costs, minimizing holding periods of defaulted assets, reducing the impact of distressed houses across the country. So essentially, these sales maximize recoveries and they mitigate long-term losses to the Mutual Mortgage Insurance Fund through a competitive auction at HUD. So just general history of our program, going back to 2010, we've sold over 108,000 loans with an approximate unpaid principal balance of $18 billion from 2010 to 2016. These were all single-family forward loans where the underlying properties were occupied and vacant. During this period, we also introduced what was known as the neighborhood stabilization outcome pools to address the potential for a large number of foreclosures of FHA-insured delinquent notes in specific geographies. So as part of these, the neighborhood stabilization outcome pools, what we required purchasers to do was to achieve a neighborhood stabilizing outcome for at least 50% of the number of mortgage loans that we delivered to them in each pool. Some of these outcomes included mortgage loan reperformance, where the purchasers would get the borrower to reperform and start paying again, sale to an owner occupant, a gift to a land bank, or mortgage loan satisfaction. Also, since the 1980s, we've sold multifamily and healthcare defaulted mortgage notes. Right now, the current focus in our program has been the HECM loans, or the home equity conversion mortgage loans, which is essentially the reverse mortgage program. So since 2017, we've been focusing on selling these notes. These are all secretary-assigned HECM notes where the borrower and co-borrowing spouse are all deceased and the property is vacant. So we introduced this initiative to address the growing inventory of these notes that were on our books because they weren't getting foreclosed by the DOJ. So they were just sitting on our balance sheet and costing a lot of money. So since 2017, we've executed 6 sales with approximately 6,300 notes that we've sold and an unpaid loan balance of about $1.3 billion. The last sale we held was in June of 2020. And in this sale, what we did was we allowed nonprofits to carve out up to 10% of the notes in each pool that we sold. So as a result of this strategy, we were able to sell 26% of all the notes we offered in that sale to nonprofits, which was the highest percentage in any sale to date. Another focus that we have right now is the direct sales. So basically what a direct sale is are assets that are sold directly to a government entity. And they can choose to partner with a nonprofit. And this is a great way for nonprofits to get into the game, basically to establish and forge relationships with government entities and that way you can obtain notes from HUD. The way these work is essentially governments, state or local government will reach out to HUD, provide us with a business proposal and a business plan that we'll review. We'll take a look at that and see if it aligns with our mission and our objectives. And then, we'll decide whether or not we want to move forward with the loan. With the sale. These sales also require the Office of Management and Budget approval. So in the past, to date, we've had 4 single-family direct sales that we've executed. And the most recent one was in May of 2021 with the state of New York, where we closed on 70 loans. Before that, we had the city of New York City in June of 2016, where we sold them 24 loans. The state of Nevada in June of 2014, where we sold 220 loans. And the state of New Jersey in 2013, where we sold 517 loans. Another focus as well is the multifamily and healthcare sales. So since 2002, we've sold about 723 notes, securing 468 multifamily assets and 255 healthcare assets with an approximate unpaid principal balance of $4.7 billion. Our most recent sale was also last month, where we sold 11 notes, 6 healthcare and 5 multifamily assets with a total of $42.3 million. So that's essentially the current focus right now. Looking forward, the future opportunities do reside with HECM sales, direct sales, and multifamily and healthcare sales as well. So we have an upcoming HECM sale on December 1st, where we're going to sell approximately 1,600 HECM notes. So what we're doing with this particular sale, which is a deviation from previous strategy, is we're allowing nonprofits and governmental entities to carve out up to 50% of the loans in the larger regional pools for this sale. So as I mentioned before, in the past, we were allowing nonprofits to carve out up to 10%, but in this sale, we've expanded that up to 50%. And this strategy is basically trying to get more nonprofits and governmental entities engaged in our sales and our program. So we think this will have a great outcome, with these loans that we sell. So also future opportunities I mentioned before lies in the direct sales. I think in the future, the direct sales, in the near future at least, will be an asset class of vacant and abandoned loans. So, moving forward into the further future, hopefully we'll be able to sell some occupied. But at this point in time, I think direct sales will be strictly vacant and abandoned loans. And this aligns with HUD's mission by eliminating blight, preserving property values, and also strengthening our communities. And lastly, I think multifamily and healthcare sales will also be, an opportunity in the future as well. We don't have any sales plan, any multifamily and healthcare sales planned at the moment, but once we do, we'll certainly make that announcement. All right. So I think what we want to do now is introduce our panelists and have them talk a little bit about NPLs, HECMs, nonprofit roles, and some of the trades that are going on in the industry. So I think we'll start with Wade Carroll. Wade, if you'd like to introduce yourself, the floor is yours.
Yes, I'm Wade Carroll. I'm the president of Anders Capital Group. Anders Capital is a socially conscious real estate investment firm. Our core strategy here is the acquisition of distressed assets, which can take the form of REO or non-performing loans. We do like non-performing loans, and we recommend NPL acquisitions to other socially conscious groups or nonprofits, as they're able to immediately impact home ownership, in that you're buying a loan with a borrower that is in crisis right now. This means you're working with a motivated individual and are therefore able to affect change very quickly. So the NPLs that we buy, they are all forward mortgages. They're generally occupied, but you're dealing with a borrower who is either now delinquent or they're no longer making payments at all. When a loan falls into this category of delinquency or non-performance, the lenders usually pool them together with other non-performing debt for liquidation. And we see this every year with Fannie and Freddie and HUD and a number of banks across the country. Most of these large firms that acquire mortgages are not generally equipped to manage assets once they begin to fail and are therefore sold off. But this presents an opportunity for those of us who do have the skill set required to manage these delinquent loans. And it's for this reason that I recommend NPLs to nonprofits and housing organizations, as they are generally equipped, either through home ownership education or housing counseling, to help these struggling borrowers.
Thank you, Wade. Keffer, do you want to talk a little bit about the HECMs?
Yes, thank you. Can you hear me fine?
Yes.
Okay, great. Yep, so my name is Keffer Norris. I'm with NorrisRefc. We do some valuation. We've been participating in the HECM HUD sales since they've been doing them since 2017. We've purchased with partners approximately a little over almost 800 to 900 loans. So what I'm going to talk about is that HECM's kind of a unique asset. We've been buying non-performing loans and loans for a very long time, and this is a unique trade in that the HECM assets are actually vacant homes, and it actually feels like when you look at the asset that someone just kind of stood up and walked out of the house, because the majority of the homes will have a lot of personal property in them. And they've been defaulted for quite some time, varies from a little under 2 years or to 5 to 10 years. I think this is a great opportunity from the nonprofit perspective, because they are blighted. They are homes that do need to be repaired. Typically, the longer it's been default and the longer that the loan has been around, the more deferred maintenance there is. So if it's if it's a short-term HECM loan, then you'll have a little bit of deferred maintenance. If it's been, if they've had the loan for a long period of time, there'll be a lot more, and that's based on the HECM project or property itself. So, the reverse mortgage is set up so that a senior has the opportunity to stay in their home and use that the equity. But that kind of disincentivizes them a little bit to then rehab and repair it during that period of time. So I think that's so you look, and that'll be why a lot of these homes haven't been updated, or you have roofs and ACs and those type of things that are problematic. But overall, my experience has been very good on the HECM side. HUD is a phenomenal partner to do a trade with. Their reps and warranties are phenomenal. So from that perspective, I think if you can get involved, this is a great opportunity to do good things in the community and work with a good counterparty.
Thank you, Keffer. So now we'll take it to Diaz. You want to introduce yourself and talk about the nonprofit roles?
Sure. Thanks, Sennai. Hi, my name is Diaz. I'm Vice President for Housing and Financial Empowerment at UnidosUS. We're a national nonprofit focused on serving Latino populations around the country. In my role, I do almost every variant around single-family home ownership, and have in my career since I started over 20 years ago. I think the important role here is that, just to kind of wrap up why we're having the conversation, is that nonprofits can play in this in HECM or REO purchase or non-performing loan purchases that governmental entities do quite often. I was with Marcos, who's executive director of HHI. I was one of the founding members of that organization. And which is also a nonprofit as well, that by kind of trial and error, a lot of work one way or the other, found a way to participate in these NPL and REO, both sales that were going on. They're going on all the time, right? So they're not. This is not like a new event. This is the programs around them have changing a little bit. Sennai talked a little about that, which are really important. But the note sales, REO sales, they're always out there. They're always out there. And the question really became, can nonprofits who have a orientation to home ownership take part? And so, what we're part of the purpose of this presentation, particularly for those nonprofits in the audience, is to begin to set a little kind of a seed of knowledge that will allow you to kind of proceed and pursue something in the future, because this is not going to be the only time a sale is going to be available. And as with the complexity, as kind of Keffer was indicating, and how Wade mentioned, they're not as easily as going to your local realtor and buying something, right? So it's a little different process. But I think, and we'll talk about a little later, why it's really important for mission-oriented organizations to be involved. I will say that, particularly in these times, everybody's first word out of their mouth when they talk about affordable home ownership is a lack of inventory, right? Very first, if they say, yeah, we really want affordable, but there's no inventory, right? It's usually the two things go hand in hand. Well, that's true. There is an inventory shortage, so I'm not saying that it's not there. But non-performing notes and HECM sales in the current marketplace are a source of inventory. And for that reason, for those nonprofit developers and other organizations who are interested in acquisition, I think it's going to be an important space that it's going to be critical to find inventory that might be relative to your marketplace, to be, kind of have a chance to get something that would be very difficult to get, in other words, particularly if you're in high demand areas. I'll end there, Marcos, and let the conversation continue.
Great. Thank you, Lot. So we'll go to Phil Thigpen. Phil, if you want to give a brief intro and talk about the trade and the GSC assets and FHA assets, please.
Thank you, Sennai. First of all, thanks for having me join the webinar today. I'm really pleased to get the opportunity to talk about affordable housing and preserving affordable housing. This has been an important element of my career. I've been working on these loan sales really since the early days of the loan sale program at FHA. I'm a director at PwC here in DC, and I'm part of a team that supports Sennai and his team on the loan sale program at FHA. We just completed our first 5 years working for Sennai and his team, and we're re-up for another 5 years. Very pleased about that. During the first 5 years, we started out selling forward mortgages where loss mitigation was the objective, and we sold almost 30,000 single-family mortgage loans, about $5 billion of unpaid principal balance. As Sennai mentioned, FHA turned its attention to neighborhood preservation, and to support that, instituted this sale of HECMs. And over our 5-year contract for Sennai and his team, we executed 6 of these HECM sales. I'll talk a little bit more about what the loans are. But 6 of those sales, about 7,000 loans, but the only path forward was for the buyer to take possession of the property. We're working on another sale now, the 7th in the series. And as Sennai mentioned, that's about another 1,600 assets that will be auctioned on December 1st. But the revolution here is that in all of the previous sales that I discussed, the loans were sold in bunches, in groups, what we call pools, of dozens or hundreds or thousands of loans, where a buyer had to buy all of the loans in that particular pool. But this time, the FHA is allowing nonprofit buyers the opportunity to buy much smaller lots on a loan-by-loan basis. This is a revolution in the sale of these non-performing loans by government entities. Hasn't been done by Fannie Mae or Freddie Mac. FHA is a leader in this space, and this is going to expand affordability and expand opportunity for medium and smaller sized nonprofit buyers to purchase single-family mortgage loans and properties from governmental entities like FHA. I get excited about this topic, so I could go on and on about this, but Sennai, I'll stop there because, as I said, I could keep rolling, but let's continue.
Great.
And thank you for joining, Phil. I know every one of you, thank you for joining. I know we're all crazy busy right now. And you guys in the audience, thank you very much as well. We're going to do some back and forth conversation here, audience. And if you have some questions, please put the questions in. We do hope to get to some of them at the end of this session. So we'll be looking at the chat room to get your questions from there. Phil, I just wanted to ask you if you could expand a little bit. I know we all talked a little bit about HECM, through this beginning of the session, but maybe expand a little bit and talk more about the current trade. Maybe give some specifics about how you carve them out, and again, add, to that, if you don't mind, the importance of the municipalities and the nonprofits participating in the space and how, relationship with nonprofit and capital partners like HHI and Keffer and Wade and others kind of lend and help to this, process.
So maybe a good place to start, Marcos, is just to let everyone know that a HECM is a home equity conversion mortgage. It's a reverse mortgage where the lender will lend against the owner's equity in the property. FHA is the largest reverse mortgage guarantor in the United States. The HECM program is probably 90% of the market for all reverse mortgages in the country. So there's a substantial volume of production of these loans. They come in a variety of types. There are loans where the borrower takes a set payment for the rest of the borrower's life, a set payment for a period of time, or a line of credit. And these are all different types of HECMs, and there are combinations. You can get a payment for a period of time and along with it, a line of credit as an example. Now, lenders, once a certain threshold is met as to the lending amount of that loan, FHA will take that loan over. And Sennai and his team begin to work with the servicing center in Oklahoma City that has the portfolio of these HECM loans that is now owned by FHA. And it is over time, some become vacant because the borrower becomes deceased, and there's no surviving non-borrowing spouse. It is those loans that are being sold where the property is vacant. In the current transaction and the previous 6, those are the types of HECMs that are being sold. So the only path forward for the buyer, is to take possession of the property underlying the loan. The loans have been sold up until now in pools, in groups, where they have been put together by geographic location. And the reason for that is typically buyers like if they're going to buy properties, which at the end of the day, these HECM transactions are because the borrower is deceased and the property is vacant. They want to have their plumber, their electrician, their carpenters, and so on to have access to the properties. And so that you're not going to have some in New Jersey and some in California and some in Alabama and some in Minnesota. You want to have all in Florida. And that's why we recommended, and Sennai accepted our recommendation, that all the loans in Florida, all the HECM loans that are being sold in the current auction in Florida are put into a single pool. Thus, it is around the rest of the country. And in the current sale, there are 5 geographic pools that have been created, 5 large regional pools. But as Sennai said, in this sale allows nonprofits to submit a bid for single loans and be awarded a minimum of 5 loans, where the nonprofit submits a sealed bid for the sealed bid auctions that FHA conducts. And if they achieve the reserve price that FHA has set for each individual loan, the nonprofit will be awarded the loan or loans rather, despite any bid from a for-profit entity. So this, like I said, this is a revolution. This is great. This is going to expand the ability for nonprofits to participate in these auctions. Because once again, at the end of the day, this is about property preservation and neighborhood preservation and expanding home ownership. And for nonprofits to be able to get groups of loans that are concentrated that they choose is going to advance the opportunity for nonprofits to participate. So as an example, if a nonprofit wants to only focus on loans in New Jersey, there are over 100 loans in New Jersey in this transaction. A nonprofit may go and qualify as a bidder through the process that we are running, and I'm happy to help anyone who needs help to qualify to go in and take a look at the loans that are being offered for sale. And by the way, taking a look doesn't mean you have to bid. You're more than welcome to look at the collateral. We have many nonprofits who participate all the time have started out by taking a look at the collateral and later on submitting a bid. But more than happy to, once again, to make access available. But if a nonprofit so chooses, he or she could select 5 or 10 or all of those loans up to 50% of the pool in a particular pool and submit a bid. So there's a tremendous advantage that FHA has provided. And once again, we don't see this at Fannie Mae or Freddie Mac, who do set-asides, but anyone can bid on those set-aside pools. Does that help, Marcos?
Yes, and thank you very much. Maybe, does it make sense at all to talk about the 7 current markets, I think, that are, or is that not really relevant? Because I think there's a Florida, there's a single in Illinois, right? There's Puerto Rico, Northeast.
So there's, Northeast. There's a Northeastern geographic pool, a Florida pool, a Northern Tier pool, which is basically Michigan over to Montana and down to Missouri, a Western pool, and a Southeastern pool without Florida. Puerto Rico is set aside. We always have in these HECM sales a small number of Puerto Rico loans. And Sennai, I'm missing one, which is the
I think it's a single family, the single pool loan with the cap.
In Illinois. There's a single asset in Illinois, which is a 4-family home with tenants in it now. As Sennai said, about 1,600 assets in this sale, with half of those available to nonprofits who bid and exceed the reserve price that is set by HUD on a loan-by-loan basis.
Thank you.
Great.
Welcome.
Thank you, Phil. That's great. And just wanted to add to that as well. That, I think currently we have 33 nonprofits that have qualified for this sale. So Phil and his team have done a fantastic job of getting nonprofits engaged with this upcoming sale. So if anybody's interested in any other nonprofits out there interested in qualifying, you can always reach out to Phil and his team. So this next question is for Keffer. Keffer, do you want to describe the process, the conversion process of a HECM loan to REO?
Sure. Thanks, Sennai. So again, these aren't REOs, but that is the goal, is to get them to REOs. And depending on your jurisdiction, there are different timelines on that. So typically, you're not going to be able to, like a non-performing loan, to get hold of existing heir or existing beneficiary. So you do an heir search, and then we have to go through the foreclosure process. So very, very rarely you'll get hold of an heir and there'll be a short sale. But the reality is you're trying to get it to the foreclosure and complete the foreclosure. You have to partner with a good attorney, and then during that period of time, anywhere from 1 to 2 to 3 years, depending on your area, if it's judicial or non-judicial, you'll have to process that foreclosure, and that'll start with a notice of default, because these have not been. One of the reps that HUD provides is they're not defaulted, have not been serviced. But during that period of time, you do have to maintain the asset. So that is one thing you'll have to consider and think about and partner with, if you're not familiar with it, with a good servicing company or an asset management preservation team to maintain the asset during the foreclosure process. That foreclosure process, let's say it takes 12 months, then you have a notice of sale after the notice of default, and then it goes to auction. Some of you may be familiar with the auction process, but that is, based on the UPB, you'll be able to foreclose on the asset and then potentially get it back at that point. So in some cases, you may not, because the unpaid principal balance is, let's say, for instance, $100,000, and the home is worth, rehab to $200,000, and you're only going to spend, $30,000 or $40,000 to fix it. An investor or someone in the courthouse may purchase that. So you have to take that in consideration when you're buying these assets. A majority of these HUD assets aren't like that, or depending on the unpaid principal balance and where the market is over the next, 12 months to 24 months, you will be able to get all the assets, probably 50% of the time, depending on your area, depending on the quality of asset and so on. But you really do have to do a lot of diligence up front to ensure, that you're, how much you're paying based on the unpaid principal balance. So when it comes to sale, you can get it back. And then once it converts, now you're able to, do what you want to do with that asset. Our team typically then spends quite a bit of money to make it market ready and then try to sell it to an end user, a homeowner, and not an investor. We do try to, one of the things we do is, we don't allow investors to buy for the first 30 days because it is critical, especially with such little inventory, to try to get these into homeowners, into the homeowners' hands. We've teamed up with some various nonprofits that bring us some pre-qualified buyers as well, so that we're able to, have somebody in the queue in different areas. But it really is the critical part on buying a non-performing loan. If you haven't bought one, it becomes your attorney, your trustee team, and then surrounding that with a good asset management team to manage the asset through the foreclosure until it becomes an REO. Now, I could, like Phil said, I can talk for hours on that process, but that's the higher level view.
Well, thank you, Keffer. That's very helpful. And so now we want to switch gears a little bit. Wade, so we've been talking about the vacant loan sales. Do you mind sharing a little bit on the occupied loan sales and the workout options that are available and the importance of foreclosure prevention counseling for these distressed borrowers? As you indicated, when you get the loan, there's a bar in place. Many times, 6 months, a year, 2 years behind, and they're pretty stressed out. So can you talk a little bit about that, the importance of the, foreclosure prevention counseling?
Yes, sure. It's nice when you're a lender on these loans because you have a whole toolbox that you can use to try to get these borrowers back on their feet. And the first of which is some type of modification. And buying non-performing loans and working with a borrower is one of those few real estate transactions where the best possible outcome for the borrower, which would be reperformance, is also the best possible outcome for the lender. So they're very aligned. And similarly, the worst possible outcome for the borrower would be a foreclosure, which is also the worst possible outcome for the lender. So from that aspect, in a way, both the borrower and the lender are working together for the same outcome, if at all possible. So to get a borrower to reperform, we have a couple tools. And the first of which is some kind of a modification. And in order to modify that loan, you can begin with just the forgiveness of a certain amount of principal, which we do regularly. You can also forgive the arrearages that have accumulated. As Marco said, sometimes these loans are 2 and 3 years delinquent, which means over that period of time, the borrower is probably also not paying property taxes. They're probably not paying their insurance. And these types of fees add up over time, and they get paid for by the lender, and it adds to the overall debt, typically making the borrower upside down. So forgiving arrearages is another, also reducing the interest rate such that the loan then becomes affordable. Housing counselors are extremely important in this aspect of modification or negotiating with the borrower. And that typically some lender has been chasing down these borrowers for some time. They're gun shy. They might not be answering their phones, and they look at a lender as an adversary. So having a counselor come inside and deal with them, work with them on the borrower's behalf, not on the lender's behalf, but the borrower's behalf. Walking through the credit files, their financials, their bank accounts, and helping them see and understand the affordability of the loan or the mortgage that they have now, what needs to be done to correct it, if anything at all. So the counselor becomes an advocate of the borrower, giving them confidence and trust where they might not see that from the lender. Additionally, you will always run into borrowers where a modification or reperformance is not in the cards. And the counselors run a similarly valuable role in working with that borrower towards non-retention alternatives, which would be perhaps a deed in lieu or some kind of a short sale, anything that they can do to prevent a foreclosure. Again, the counselor is looked as a trusted intermediary, so to speak, and is invaluable in all aspects of that, from the modification to some type of foreclosure prevention or non-retention alternative. Does that answer your question mostly?
Yes, thank you, Wade. Thank you very much.
Yeah, thank you, Wade. That was great. I think you made a very important statement there in terms of the alignment of the interests with the lender and the borrowers. So that's very important. So this next question is for Lot. Lot, should nonprofits participate in this space? And if so, why? What is the community benefit and the benefit to them?
Great. Sure. Thanks, Sennai. Yes. Well, I'll start by saying, like, I fell in love with affordable home ownership a long time ago because of the impact it had on families. I mean, anybody who's been working in that space and the trajectory and the ability to thrive in a community that home ownership provides has always been a central part of not our organization's thinking, but as my career as well. When the foreclosure crisis hit, for those of you who still remember the foreclosure crisis, over 10 million people lost their homes to foreclosure. Okay, that's a lot of homes, and over half of those left the for sale market and went into rentals, right? And the loss of wealth to families in that conversion they were hit twice. Not only were family they lose their homes when anybody tried to get back in the market, there was no inventory left to purchase, and so the whole inventory thing was aggravated worse than it might have been otherwise. So that in of itself is probably a travesty. I know none of us want to see repeated. But one of the kind of little kernels of hope there was, again, if you can orchestrate a mission-oriented organization like a nonprofit, they can have significant impact. And so the way I kind of look at it more specifically, so if you have three types of buyers, we'll simplify this a little bit. One, that's a private consortium of investors that is out in the market for assets. A mom and pop investor who's looking to buy assets for their own portfolio, or a nonprofit organization whose mission is focused on getting communities of color or LMI families into a home purchase situation. If those are the three bidders and the bid is made, and of those three, two are more profit maximizers. They don't necessarily, they're going to all turn them to rentals, but they're trying to profit maximize. And so there's how they go about the selection process, the amount of time they'll wait, all these kinds of things will be impacted because they have a model they're implementing. They have to stick to that model by and large. Well, a mission-oriented nonprofit can be a little bit more flexible in what it's doing, and particularly, I see that in the purchases that we've been involved with Hogar Hispano, is that two things have happened, particularly in the MPLs, that we had a direct relationship with the servicer in a way where we could get an outcome for the borrower, which was very different than other servicer relationships that our counseling networks have had over the years. And so the issue here is that you get, because of those relationships and how they're aligned, you get better outcomes. For the case of folks at MPLs where the borrowers are still in the house, they have to stay in their house. There's many stories that we could relate on that particular picture. And although they're just a number on a spreadsheet for many, to those families, believe me, it was no number on a spreadsheet. It was their life. It was their life in some cases. And so I just think that ingredient in these transactions is really critical, and nonprofits play a big role there. I think in this current environment, which is people coming out of the pandemic, and we're not sure exactly how it's all going to shake out relative to the mortgage markets, and how is foreclosure going to be a big wave, small wave, or it's normal wave? Nobody really is entirely sure how folks are going to come out of the pandemic. Hopefully it's better than the last one. But regardless of that, there will be foreclosures, there will be REO sales, and the idea that nonprofits can reorient the trajectory of an asset in an FHA portfolio, in a Fannie portfolio or GSE portfolio, can make a huge difference in many families' lives and the community in which they live in. So, I guess the thing I would kind of put on the mission side of this is it's complicated. Just like if you do single family development, it's complicated. Any development's complicated, but the outcome is worth the effort for many. And so I would consider these types of acquisitions in that similar vein. They're complicated. Nobody's trying to say that they're easy and simple, for sure, but the potential impact on communities are significant as well. And so for that reason, I myself, and I think others here, are encouraging, if there is a partnership, and we'll talk a little bit about that later, to get involved with these sales, it's worth the effort and kind of research needed to kind of become an effective bidder in these pools.
Totally agreed. Thank you. So the next question is for Phil. Phil, how many loans are sold annually between HUD and the GSEs, and how do non-performing loans get pooled and marketed for sale?
So we can do a compare and contrast between FHA and Fannie and Freddie. For Fannie did 2 non-performing loan sales in 2021. Those loans were sold in large pools, and they were put together according to loan to value of the property underlying the loan. So for each non-performing loan, they looked at the loan to value and they put those loans together, unlike FHA, that in many cases focuses on the geographic location of the non-performing loan. The first sale Fannie Mae did was in June, and they sold 8,090 loans, and that was $1.6 billion of unpaid principal balance, and that was in large pools, 4 large pools. They also sold what they call a community impact pool, 400 loans of about $96 billion, and those community impact pools are geographically concentrated. The second Fannie Mae sale this year was in October, and it was a larger sale. They sold 11,400 loans, which is $1.7 billion of unpaid principal balance. And they sold a $45 million community impact pool. Fannie did not conduct a non-performing loan sale in 2020. So what we can draw from that is that really on an annual basis, we see Fannie Mae show up once, maybe twice, but it's irregular. In the case of Freddie Mac Freddie Mac also puts its pools together according to the loan to value of the loans. And this is, buyer preference. Some of their buyers some are the same and some are different from the FHA buyers, have a preference because they think that their loss mitigation strategies are effective if they can choose the loan to value of the loans in a pool. Freddie Mac sold $1.3 billion of non-performing loans on October 14th and a smaller pool of $18.4 million on November. Is going to go on November 16th. In August, Freddie Mac sold about $185 million of NPL, and previous sale to that was $464 million in October of 2020. Freddie Mac has said publicly that they're going to be in the market annually with an NPL sale. As I mentioned, FHA pools its loans according to with a different view, and this is from recommendation from its advisors, including me, which is bidders like the geographic concentration, and they also care for the larger buyers about the number of servicing transfers, which is how many different companies are servicing the mortgage loans and have to transfer. But with the HECM sale, all the loans are in Oklahoma City. That's the servicing center, the National Servicing Center for FHA. So all of the loans are being serviced by a contractor on behalf of FHA. And once again, our recommendation to FHA that Sennai has accepted with his colleagues is to think about these sales in geographic terms, in terms of concentration, because in terms of the HECM, the only path forward, as we've discussed, is to take possession of the property, and you want your team to be able to work in a geographically concentrated region. Now, some buyers have specific regions that they like. Some have maybe as an example, Arizona and New Jersey. But they also are willing to look in other parts of the country, like, say, Detroit, where the very first pool of loans that FHA sold to, or as a set aside to nonprofits, was transacted. So, in summary, larger pools from Fannie and Freddie, from Fannie Mae and Freddie Mac of non-performing loans, sold in groups according to the loan to value of the loan in pools, as opposed to FHA. And once again, I can't say this enough. This is revolutionary, that FHA is allowing the nonprofit community to bid on loans in much smaller blocks to allow a wider participation. There it is.
Thank you, Phil.
Welcome, Sennai.
All right, so this next question is for Wade. Wade, are there any other sources of NPLs available for acquisition?
I'm assuming we mean other than the GSEs. It sounds like HUD is going to step aside for a bit. Obviously, Freddie and Fannie typically sell NPLs. But yes, what's nice on the NPL side is, especially regionally, there's almost always local banks, small regional banks that sell these types of assets. None of them are equipped to properly deal with a delinquent loan, so they typically sell them. So for those smaller groups that are, say, in Orlando, they're regional Florida banks that you can reach out to and buy. But on a bit larger scale, the large hedge funds, the big trusts that accumulate these types of assets, they are constantly selling non-performing loans every single day. I probably get a dozen lists of assets every single day of non-performing loans that are for sale all across the country. So yes, there's many sources of those types of assets outside of these very large auctions that we've been talking about today.
Thanks, Wade.
Thank you. So, Keffer, can you describe maybe from your perspective and from what everybody else has talked about, especially the housing counseling piece, what role can the reverse mortgages play in the provision of affordable housing, especially to, Black and Latino and marginalized, people and families across the country?
Oh, absolutely. And it can play a very big role. Again, because there is such a shortage of housing stock right now, you do have the opportunity to be a savior for a lot of people, because you'll have an asset that you can control who the ultimate buyer is. So when you do get it, if you have a pool or a group of qualified buyers that you can bring to the table, this is what these assets allow you to do. So again, a majority, especially in locations that I work in, these homes are, reasonably priced. They are that affordable housing bucket, and so you can be creative. You can give some down payment assistance, because you're buying it at a discount. We constantly, if I have a veteran, we prefer veterans. We do those type of things, and again, that opportunity to give that first look is really the key. When you get these assets back, that you're able to pre-qualify and have a bunch of buyers ready, and not have to go to market where it becomes overpriced. Our philosophy a little bit is, hey, if you hit your target, you don't have to get greedy. It's good to leave some meat on the bone for an end user, right? That becomes the challenge in today's market. When you put a property out there and it becomes it becomes an overbidding process. It's not necessary to do. You can take a number that makes everyone happy, down payment assistance, and it works out well. So I think this is a great product. I would say 95%, or if not more, of our homes that we get back are sold to end users. I don't have the stats for Black and Latino, but a lot of the assets are in areas that'll serve that. We do have some, because these are HECM loans, right? They were senior loans, so there are some that are in senior communities, 55 plus. So that kind of narrows that bucket down a little bit, but a majority of these are not in that location.
Great. Thank you, Keffer. So this last question goes to Lot. Lot, do you think it's good for nonprofits to partner with investors in order to become active in the NPL space for the provision of affordable housing?
Thanks, Sennai. The short answer would be yes, but there's a critical element of it. The path that the investor sees properties going and the path that you see nonprofits going has to have some alignment, right? In the case of what Keffer explained, they want to put the house in the end user. That's the kind of partner you want to kind of work with as a nonprofit, because you do as well. And so the first key element is there alignment of goals? If there are, then investors can play a very beneficial. We haven't said it, but we've kind of intimated, but we're talking if you're doing a pool, we're talking millions of dollars, right? We're not talking, 500,000 even. It's they're large transactions. The smaller pools that Phil talked about are going to help a lot, because obviously they won't be, kind of stuff you hear Fannie and Freddie doing, but it's getting that money together, getting the process together. Investors play a critical role. The key thing, and when speaking of the experiences we've had both HHI, is leverage and pool acquisition size, all those kinds of things. It's kind of a puzzle you're always putting together in some ways. In our models, investors always play a large role, because two reasons. One is, not only do they have the cash to invest, but they have, in most cases, have ground games to kind of resolve the asset along and mutually agreed upon goals. So those are both critical elements to purchasing assets and making sure you manage them and put them in end users or the result of them in a positive way. So I think the two reasons, just to summarize, again, alignment of goals is a first question you have to resolve with a potential partner, because if you're misaligned there, you're going to hate each other within 30 days after the sale, and that's not very fun for anybody. And so that's the first thing. And as you're thinking, depending on your role with that partner, so you can start as like we did, really, in some ways. We were the housing counseling partner to a transaction, and as was stated a couple times, housing counseling, particularly with NPLs, is really helpful in getting the best resolution. And whether it's the quickest way, I'm not sure, but an effective way. And in that process, you kind of see some of what, how the assets work and how the transactions occur. When you're putting them together, you're kind of like, in my case, we're a nonprofit. We have access to pools that for-profits can join us in and help us win a bid. And you'll see lots of examples of that in the bids coming up for the HECM pool we've been discussing. Again, I just say it's really important that and last thing I would say, everything should be in writing, right? So if you have you need to get an operating agreement just to make sure you codify the goals that everybody's agreeing with in a process. And that will vary depending on the role. Are you bringing money to the transaction? Are you not bringing money to the transaction? Are you providing services to the transaction? All those things have to be codified one way or another in an operating agreement. And just like any other development process, you would think as if you were a developer in a community.
All right. Thank you, Lot. Thank you, guys, all of you. Before we go to the Q&A, I just want to sum up for everybody. Again, we're talking about how the acquisition of loans, regardless of the type of loan, as you heard in this panel discussion, how the acquisition of loans can lend itself to creating affordable housing or preserving affordable housing for Black and Latino and other marginalized communities and LMI, low to moderate income families and individuals. And I know that this is a lot of information crammed into one little spot, but I think the kind of key takeaways is nonprofits typically don't have the type of capital necessary to acquire in a larger pool. And it is a challenge to then enter with lender or investor partnerships. And so if you're going to go do it, I highly recommend that you first and foremost state your mission to the capital partner and help them understand your goals and objectives. Secondly, understand the requirements from HUD, because in the 50% set aside, there are some neighborhood stabilization outcomes that Sennai talked about earlier in the beginning, but you won't remember them, right, until you read them. So know what you are obligated to deliver on. Know what your corporation's mission and purpose is. Make sure your board is bought into it, and then make sure the capital partners understand you so that you don't get into a relationship where the capital doesn't know what you're trying to do. And to Lot's point, it's better to not get in a relationship at all on the front end than to get into a bad relationship on the back end. So please do your due diligence, do your homework. And then lastly, in this shortage of assets, of REO assets, you heard Phil's description of the volume of NPLs on the market, right? And there's a lot of volume. And so if those of you who are REO, single family scattered site providers, are seeing a lack of inventory, you might want to consider getting into the NPL space, especially on this HECM type pools, because as everyone kind of mentioned, these HECM pools are primarily an REO play, and the foreclosure responsibility falls on you, the buyer, The DOJ is not going to do it, so you, the buyer, have to do it. And then lastly, if you're the nonprofit buyer and if you structure it correctly with your capital partner, you are the lender, you are the investor. So you set the rules. So once you have that pool of assets, you can do a reinstatement. You can forgive principal. You can provide counseling services. And that's why counseling services that Lot mentioned is so critical to us, especially, well, actually on both ends, on the foreclosure prevention side of things and on the purchase of REO side of things. It's better to have an informed buyer and now owner than to have someone that doesn't really know what they're getting into. And then my last statement before we go to questions is to the banks in the world. This is a space that you need to invest in. Currently, the only ones investing in this space are private investors and private equity firms and hedge funds. And this is a space that the banking industry should be investing in. And, you know, nonprofits like ourselves, HHI, who has vast knowledge and many years of experience, would make good partners for you. And the community that you serve is primarily a CRA, activity that you would benefit from. So please consider this space, and let's go out and buy some NPLs and create homeownership opportunities for our Black and Latino and marginalized brothers and sisters. So now I'm going to go to the questions. And this first question is for just about anybody on the panel. I think it's a fairly easy one. From Jeanette Wright, how does one avoid trespassing if they don't necessarily own the real estate? And how do they maintain it through the period that they own the asset? Anyone want to take a shot at that?
Yeah, I can speak to that. This is Keffer. So you have rights by the note to service a property that is vacant and abandoned for preservation purposes. So once a home is abandoned or vacant, you give notice. You can knock on the door, and you're allowed to do property preservation. You do have to leave any personal property. You can't touch it. You have the right to secure it, lock it, those type of things. Enter it. So your preservation team, which we have, will visit the property once a month or once a quarter. Then you also have to take over lawn service. You also have to take over paying property taxes. It's basically becomes yours, but it's not. But you have to maintain the asset. And typically, you'll have to also register with the city that is a vacant or abandoned, that you are the contact. So if there's any issues that come up there.
And Sennai, would you mind maybe expanding a little bit on, I think there is a requirement for servicer participation when you buy some of these loans?
Yeah, so I think the requirement is just to service these loans in accordance with industry standards, to preserve the property, pay taxes, insurance, and things of that nature, just to protect the asset. So I think as long as you're, fulfilling those duties, then you're on the right path.
Right. And for those of you, again, that are going to be new to the business, it's important that you have a qualified servicer. Make sure that servicer is licensed in the market that you're in. And typically when you have a servicer, they bring their own property preservation team. They also, ensure that the taxes are being paid, insurance is being paid, and that your asset is being protected. And to Keffer's point, the property preservation team does go out and secure it. And also to everyone else's point about the vacant, the HVLS, the HECM vacant loans, you can gain access to them. So with your servicer, you can secure those assets. Anybody else want to add to that? So from the audience, we have a lot of questions about how do we contact you guys on the panel. I think that our information is available to you. So maybe reach out to the folks at Big Marker to ask that question. There's another question that Phil, maybe you or Sennai can answer. I think it's from Al Pena. It says, for the upcoming December 1st auction, what is the minimum amount of properties that a nonprofit can bid on?
5.
5?
Yeah.
Okay.
Well, no, the minimum award is 5. And they don't have to be in the same geographic pool. They may be in different pools, but the minimum award is 5 properties, 5 loans.
Okay, and then I think the last question, we had a few questions that we've been answering while we've been talking about, but I think there is one question that's kind of been asked already, but what does one have to do to be able to bid on the auctions? And I think, Phil, you had mentioned, you could lend support or whatever, but is there a website that they should go on to, or?
Well, in order to bid at the auction, an entity or individual has to qualify as a bidder. If it is a for-profit entity, that entity must complete a confidentiality agreement and a qualification statement. And there's a net worth requirement as well. If it is a nonprofit entity, the nonprofit entity must complete the confidentiality agreement, the qualifications statement, but also a nonprofit addendum, which basically lays out, what the nonprofit does. And those 3 documents are submitted to the transaction specialist, the team that I'm a part of, who evaluates and recommends to Sennai and his team that entity be qualified to bid. Upon qualification, the entity gains access to the data room to view all the loan level information regarding the transaction, which is going to, including the transaction documents, which is, as we've said, going to be conducted on December 1st. Marcos, I think you mentioned that our email information is available to the audience. If so, anyone who would like to reach out to me, I'd be more than happy to hear from you to assist you and your organization to get qualified and for the December 1st auction. And once again, viewing the collateral information and the transaction documents after you are qualified, and it is only qualified bidders who can view that information, does not require you to submit a bid on bid date December 1st. As I said, some folks have chosen to take a look the first time, get closer the second time, and then submit a bid later on down the line. And that's been a strategy with these FHA auctions because they're complicated. There's a lot of documentation that Sennai and his team require, and you need to know what you're doing in order to get it right. And so, as I said, some people will use auctions as practice runs and get the chance to look at the collateral to see what it's all about. Others choose to bid that first time around, but I'm more than happy to help anyone who has interest.
Okay, and we're going to take one last question before we end the session. We do have a couple of closing remarks, but this question is for Eunice Barnum. And Eunice, before I read it out loud, I just want to tell you that this might be one that you might want some legal advice on, but if any of you guys know the answer to this or think you know the answer to this without giving legal advice, right, please do. But Eunice is asking, she's saying that her nephew basically willed her 10 properties, and the properties were held in an LLC. And she's asking if she, since she has the willed assets, can operate them under that same LLC. Anybody want to try and take a stab at that? No? Okay.
I would say an LLC is fine, but if we're speaking about the nonprofit set-asides, you'd still need some type of arrangement or partnership with a nonprofit to be an approved bidder. But an LLC structure is typically what we use as well on our side.
I think what she's talking about, Wade, is outside of the pools. She was actually willed some assets, and those assets came with the LLC of her deceased nephew. Sorry for your loss, by the way. And I think what she's saying is, can she use the deceased nephew's LLC to manage the 10 assets that she now owns?
Oh,
Not necessarily.
I would hire an attorney, but yes, again, an LLC would be a perfectly good use for real estate deals, in my opinion, as a non-legal person.
So Eunice, I agree with Wade. Hire an attorney, please, or get attorney advice on that question. So let me thank all of you guys. You guys did a fantabulous job. I know all of you guys are super crazy busy. Thank you for the couple of hours of commitment and all, even more than that, because I know you all had to do some prep for this. So thank you, Sennai, for moderating. Thank you, Wade, and Keffer, and Phil, and Lot for being on the panels, and what fabulous information you guys have all provided. And before I go, Wade, they're asking for your email address as well. I think you put it up there, but just in case.
I'm doing it right now.
Okay, so to all of you in attendance, we hope you got some information from this. We hope you learned something. I would like to invite you all to come back on the 18th for the next session at 1 p.m. Eastern Time. The Office of the Comptroller of Currency will be presenting. Andrew Moss is the Director of Minority Outreach. They regulate over 70% of all the bank's assets in the United States, including all national banks. Access to capital is the fuel that will address the racial wealth gap. Moderators engaged in Project REACH on their efforts to address racial economic inclusion. Project REACH promotes financial inclusion through greater access to credit and capital. REACH, for those of you who don't know, stands for Roundtable for Economic Access and Change. And the project brings together leaders from the banking industry, national civil rights organizations, business and technology to reduce specific barriers that prevent full and equal and fair participation in the nation's economy. So see you guys on the 18th. Thank you all very much. Thank you, all of you on the panel. Have a wonderful day.
All right. Thank you.
Thank you.
Thanks, everyone.
Thanks.
Bye.
Thanks.